Hey everybody, seeing if the setup is working. Let me know in the chat if this is coming through. So far I see Complicated Cat, Reese, and Der Schlupp and Shrey J. Just to make sure you guys can hear me. It looks like this is saying that the bit rate is a little bit low. I'm on the hotel Wi-Fi, as you guys know. I can always switch over to the phone because I have good service. So let me know. Okay, cool. Sounds like it's coming through all right. That's fantastic news. So, I hope everybody had a killer week. We're still kind of cruising around in some different spots right now. We are in a pretty cool spot, actually, overlooking Central Park, which is pretty fun. Just had a chance to walk around, go see like the Rockefeller tree and stuff, which is really, really neat. They have the roads blocked off and whatnot. So it is very much full swing tourist season here, tons and tons and tons of people, which is actually kind of fun. It's a really, really cool vibe for the place as a whole. So pretty stoked on everything so far. We'll see how the rest of tonight goes. We'll probably go for a walk later and stuff. So the game plan for today, I thought we'd walk through the market as a whole. And then I want to spend a little time taking a look through some individual, things that look interesting to me. And then I'm hopeful on Sunday we'll be able to do an Outlier Pro live stream. I'll give you guys some updates on just different things that I'm trying to reposition into. Again, right now we're still in travel mode, so not going to be a whole bunch of new risk going on. The portfolio as it sits right now is very, very light. It's mostly utilized through box spreads, actually, that we just put more on today. So I still have the TQQs, UPRO, IBIT, which are all just standard ETFs, leveraged, except for IBIT. IBIT is not leveraged. And then from a directional play perspective, it's super, super light. So the portfolio is quite boring right now, but boring is good because it's essentially what we want it to be. Now, one admin note that for anybody that trades box spreads, we have an interesting opportunity here because the current risk-free rate for a 28-day trade, the reference risk-free rate is 4.32%, and the box spread that I got to fill on today, obviously in SPX, was over 5.1% annualized. So the reason why I bring that up is like that's a massive, massive opportunity as it sits right now with the market and the recent rate cut. And there's a couple things I've learned about setting up these box spreads that make them way more lucrative on the fill side of things. But the Cliff Notes version of it is right now on box spreads, especially days like today, we will get a lot of premium just for providing liquidity. So today, the fill that I ended up with was like 3/4 of a point greater than the risk-free rate, which is, again, not insignificant. So, Reese says, do you exit core positions as well? No, I don't. So core positions are just sized down. That's pretty much it. And then it says that the stream is not receiving enough video. Is it coming through choppy and stuff? If so, again, I'll move over to it looks okay as I take a peek at it. Just want to make sure it's not miserable. Let's just leave it like this. If the stream starts getting bad, just let me know in the chat, and then I can move over to the hotspot. Because I just kind of can eyeball on the chat. So yeah, Reese, no, I'm not exiting core positions. I sized them down, but the main reason why I sized them down was from the conversation we had, right before the Fed meeting, about wanting to take some of that risk down, specifically in UPRO and TQQs, and that was just a qualitative assessment of where the market happened to be at the time. And then now we have, let me grab IBIT, because IBIT's been kind of a fun trade. I have the core position built inside of a covered strangle, but I'm trading long puts around this. I actually exited the long puts today. I had some on, took some off, and then I ended up scaling more on just because of the gap down on here. And the trade itself ended up coming in pretty well. I took it off today, and then I'll see how I decide to continue swing trading the long put side of things. But this has been an interesting trade because normally with a covered strangle, I won't add long puts onto it. I normally trade the covered strangle as a standalone thing, but I'm essentially having two pieces to this trade, and it's mostly just because of the volatility that presents itself with Bitcoin, and I'll probably continue to apply that, to be completely honest with you, because I don't see a reason not to. So yeah, let's take a quick stroll through the market as a whole. The S&P 500 had a significant rally today, but still down on the day. And most of this comes from, I think I might have done it in a market update video. I don't remember talking too much about it. I did, on Wednesday. Because the market right now is super, super hesitant. And after the Fed essentially came out, they cut rates in line with expectations, but then they said future rate cuts are probably going to slow down. And I think the market got really nervous about that, a bit pensive. And now the market is pricing in what we got for PCE today, which came in a little bit better than expected. But the overall tenor that I see in the market has not declined at all. So we see net highs, lows. It's still expanding to the downside. It's expanding to the downside on the NASDAQ. It's expanding to the downside on New York Stock Exchange. The advanced decline cumulative average is rotating down. This is a 50 period for the NASDAQ. So things, as I generally see, lead to the same outcome that I've discussed with you for a little bit now, which is completely cool to find opportunities that look good. There's a lot of those still, but the market is still in a bit of a transition phase. And I think that while it's in these kinds of periods, it's just typically better served to bring risk in a little bit for more trending and momentum style plays. For volatility style plays and stuff like that, you can kind of get away with whatever you feel like here, because volatility trading in periods like this are typically really solid, actually. Lauren says Jerome came to that meeting with an attitude. Yeah, well, I feel like for him, it's got to get a little frustrating after a while when you keep telling people exactly what you're going to do, and then they lose their minds when you do exactly what you said you're going to do. Right? It's kind of like this very strange thing. Now, obviously, there's more to it than that. Actually, this is a great learning point, especially for the beginner element of tonight's live stream. What happens with the market is the market doesn't just take people at their word. They try to perceive information and then forecast things out and discount future earnings based on that information. So when we have the Fed and the expectation of the cut that we were going to see, the Fed is messaging very clearly what that's going to look like. However, people are still doing their best to try and see if there's anything that's not being accounted for in what's being discussed. That matters because that's why we can have instances where the Fed is essentially executing exactly as the Fed said it would. And that still pisses people off because they're trying to look in the margins and see if they can find any marginal opportunities, which may or may not be there. Now, side note, the seltzer water for tonight is Hal's New York Seltzer Water. This is from a convenience store that's right around the corner, and it's super, super good. Big fan. So shout out to Hal's and their seltzer water. You know your boy's a seltzer water connoisseur. So yeah, that's kind of the broad market stuff. I want to dive into a few specific things with respect to the market as a whole, and then I want to get into the focus topic for tonight. And the focus topic I wanted to talk about, I think, is quite pertinent to where we are in a market cycle right now, which is self-assessing proficiency. So last time we had spoken about creating an audit process, and the audit process is really designed from the element of how do I review what I'm doing, collect feedback, integrate the feedback into the process, and then hopefully have a better process at the end of it. Now, self-assessing proficiency is more from a learning element. And I think as we come into an end of year period, a big calendar year period for a lot of you, I think being very intentional about considering what you did this year, what you learned, how that's helped you, how it's fallen short from what you need, and then using that information from a learning perspective to help you forecast out what you're going to try and learn over the next year. And by being intentional about it, you prevent a lot of the whipsaw. I was thinking a little bit more about this from a few of our conversations, and I think sometimes people might take the way that I plan and over apply the planning element and almost make it too rigid. And I was trying to think of like different ways to help people strike a balance between a little bit of open-ended, not necessarily completely charted out learning, right? More sporadic and event-based, whatever's going on, against more intentional roadmap learning. And that's one of the things I want to talk about tonight. Because I think striking a balance on that is really useful, because the way I split those two mentally is things that are conditional to a specific scenario that you happen to be in or a curiosity that you're chasing down. That's one style of learning, and that's one path to go down. And then there's the much broader intentional path of trying to build a skill set. And one of the really great places to use an example for this are people that practice jujitsu at all. Because in jujitsu, they have different levels. And in the beginning levels, your goals are pretty simple. And funny enough, the goals translate, I think, really well to the market. So as a white belt in jiu-jitsu, you're meant not to be subbing people out. You're meant not to be controlling entire rounds. You are literally meant to be able to escape from being mounted and not be suffocated. That's pretty much it. Those are your primary goals. You're going to get joint locked and stuff like that. You can't help that. But you can definitely learn to protect your neck really well and not get suffocated to death. So the corollary to trading is, as a beginner trader, your job as a beginner trader isn't to say, I want to return 30% a year and then go crush 30% a year. It's just unrealistic. Just the same thing for that white belt. It's unrealistic for them to think that they're just going to go sub a bunch of people. Again, the goal for a white belt is to learn how to navigate through positions, last 30 seconds longer. That's what she said. Last 30 seconds longer in a round. And then the next round, try to last 45 seconds before you get caught with something. And then try to last 60 seconds before you get caught with something. You already know you're going to get caught with something. You literally know it going into it. Because if you're playing jiu-jitsu against somebody that's skilled compared to you, it is quite literally inevitable. It's going to happen. And in trading, it literally is, it's so funny to me as I was thinking about the example, because it is literally the same thing. Except in the beginning of trading, new traders start this thing without being humbled by the market, sometimes immediately. Because again, in jiu-jitsu, it's completely different. If you go to the gym on the first day, I guarantee you, as long as it's a decent gym, you're going to walk out humbled. I guarantee it. There's not that happening. But the market is different and really elusive, because it can show you prolonged periods of one thing, and then you can start to think that, oh, I kind of got this down, or, I'm really good at this. Maybe I just have a natural inclination for this, and it might not actually be true. So that's the goal for the focus session for tonight is to walk through this a little bit more. But before that, let's take a look at some of the broader market elements that I want to show you. And again, I've been showing you this. This is something I look at, as you could tell, every single day. And it's important to look at, because this is one of the slickest ways, one of the absolute slickest ways to keep a pulse on market breadth without a lot of effort. Now, you have to develop a relationship with this because you can't just look at this and say, oh, wow, 74% we're advancing today. This is great. Like we're great now. We're good. It's in context. What we want to do is track over different time frames what the relative numbers are. And the reason why that's really useful is because it helps you track how, in this case, a specific exchange is starting to ebb and flow. So while there absolutely are advancing issues today, which is great, it's really, really good, but if you take a look at it compared to a 5-day MA period, a 1 month, a 3 month, it's still relatively weak. Now, this is one of the things we should keep an eye on for the next couple days, because if this looks okay for the next, 3-4 days, and it's being supported by broader market volume, then I actually like this a little bit as a place to start adding more risk and to try to catch some of the momentum factor that we might be stepping in front of. So if we take a look at SPY, we can see that this sell-off is one of the bigger sell-offs that we've experienced, especially single day, like near all sell volume, people just punishing SPY. And it's starting to get bid a little bit here. But you'll notice that there is a volume node here that developed based on this price level, clearly, because this is what people started buying up out of. So this price level becomes really important, actually. And the reason why this becomes very important is because this is where buyers stepped in at a pretty meaningful clip during a generally broad market downturn. So now, if that doesn't happen again, and we get to this kind of level, and then the market starts to roll back over, then that means there's a really solid chance for a pretty healthy correction to start entering the picture, at least in terms of probabilities. Not saying that obviously that's guaranteed to happen or anything like that, but it definitely becomes a higher probability event. So I'd keep that in mind with the broad market levels here. And then again, as per usual, we can always see where these real pockets of strength are. So Tesla is finally taking a beat. Tesla, and when I say beat, I just mean like taking a break, not getting beaten down, because it's still near just parabolic highs. But when something runs like this is exactly how the consolidations tend to go, because they become really overextended. There hasn't been any sort of significant basing that's gone on. So there aren't people that are already willing to step in at these price levels and say, yes, I like it. No, I don't like it. And it leads to definitely more velocity in the price movement that we see. So Tesla is an interesting one because it doesn't look like it has real support until down here at like the 340s, 350s. And I don't actually hate this as a downside fade if it continues the strength. And again, the other reason for that is because when we see the market is up pretty big on the day on fairly broad support, the fact that this is choosing to roll over at this point, that tends to tell you that buyers are getting a little bit tired of stepping in. And then the downside starts to, again, just look appealing. That's not with any of this stuff. It's all probabilistic. It's actually one of the reasons why I hate when people talk about trading the market as if they know what's going to happen. Nobody knows. It is always a game of reviewing information, updating your mental models, and then making a probabilistic assessment. Part of that probabilistic assessment is weighing how comfortable you are and what the risk and reward opportunities are, because they're very, very different. So for something like Tesla, you have to, it begs the question, what's the probability of this flying up to 550 versus it being around 475 and rolling down to 400? It's, again, not a clear answer. I don't think people know inherently. But we can look at it from a probabilistic perspective and then make a decision based on that, which is exactly how I try to think about trading. I try to think of it I think a lot of people would do themselves a giant favor if you relinquish or release yourself from the burden of feeling like you have to accurately predict stuff, which that's less so the game. The game is probabilistic analysis, weighing risk and reward opportunities, and then making a decision based on probabilities, not playing Nostradamus. So Tesla looks interesting here. The other thing that we have to take a look at is energy sector. The reason why we have to look at the energy sector is because when energy finally has anything resembling an uptick, we want to see what in the energy sector is still sucking wind. That's showing defined weakness in the broader sector, even as it's having a slight relief rally. And we've talked about XLE ad nauseum now. I've started talking about shorting it from literally back here, and then especially on this day as it falls below this point of control. We looked at it again as it fell below here, this next even remote support and resistance level. So energy is in a fairly deep correction at this point, and it's almost bear market territory. Not quite, but it's almost in a bear market itself. So this is a pretty aggressive correction that this is sitting in. So this has a little bit of price support down here at like 83, and then below that it starts to look closer to something like 80. So it's just stair stepping down. And let's go into the sector though, and based on all that, let's see where the weakness is. So let's take a look at COP. And then I'm using the chart right above my head. So COP is still showing weakness, because even though it had an up day, it like hardly closed above where it was yesterday. Let's take a look at SLB. That's what I'm talking about. This can't catch a bid. The rest of the market today had a bit of a rally. This is just turning over. So let's zoom out on this. I want to see where anything resembling near-term support might be. Here, it's on it. So below this, below this, it's not until like 33, 34 that it might start to grab something to hold on to, which is very interesting. So this is a good example of not just weighting probabilities, but also what I refer to as severity. And this is something that we use in the military. It's called a RACI matrix, RACI. And the way that we use a RACI matrix is we evaluate different things, and we evaluate them on two conditions. We care about the likelihood, probabilistic outcome, and then we care about the severity. So, and I've told you all about this many times, and I continue to reinforce this point because I think it's so important for you. So if you have an event like this, it's a pretty easy event to analyze from a probabilistic nature. So let's just use this as an example. Let's say that we think that there's some sort of price level here. Let me grab an actual price level. Down here at 33 3/4. And it'll probably go away in here because it's not down far enough. So 33.75, that's about where we see the downside. And then upside, we can kind of see that this is the closest area to resistance to the upside. And like a break above resistance would be something up here, like 40.77. So this would be the upside range. So what we can do is we can say, all right, based on the way that this thing is going, what do I think is more probable? Do I think it's more probable that it's going to roll here to 40.77, or do I think it's more probable that it's going to roll down here to 33.78? Now, those are skewed metrics, because if we're looking at a normal distribution, one of them is much closer than the other one. So then it would inherently favor to the downside. But we can use the volatility surface to actually come up with true probabilities based on volatility, not based on a normal distribution necessarily. And Then we have to take a look at severity though. So what that means is, let's say that we analyze a trade in here. Let's pretend that we want to trade SLB to the downside. And I want to be clear, at this point for that kind of position, you are fucking late. Way too late to the game. Not too late necessarily, but very late. This isn't the right time to enter a downside trade on something like this, because this has become a much higher risk entry because of how far it's already moved. But I want to use it for the analysis perspective and discussion that we're having. So now let's take a look at the severity of us hitting 40 point. What happens when we hit 40.77? And then what did I say? 33 and 3/4? So what we do is we add those two in here. We add 40.77 and then 33.75. So at 40.77, we lose 260. At 33.75, we make 190. So obviously we lose more, but it's also a further move. It's not really a fair apples to apples comparison. So now we can take a look at an actual probability range here, and we can say that we expect to be in the trade for like 2-3 weeks. And let's move this to a touch because we don't need it to be in the money. We need to touch the price that we might manage at. And let's take a look. We said 40.76. It's literally about a 16% chance of it getting there. And then 33.75, it's like a 20% chance. A little more than that. 25% chance. So the probabilities actually aren't that great in terms of a skew, right? Because if you think of it, you're risking almost, $100 more, so maybe a third-ish more, but you're only getting a 10% edge. Now, that's one of the issues, again, for this being such a late entry. The probabilities start to not look as great. Now, from a non-probabilistic perspective, I personally would probably stop myself out down here if it broke above 39.81. Something like that. I wouldn't wait until this point of control from, again, like a general practitioner standpoint. I wanted to use this as an example of picking an area that might be perceived support or resistance, and then to create a probabilistic analysis from there. So from a practitioner standpoint, though, this would be more of my exit. And I would take an early exit because I don't look at this as the probability of this going up and down the same. I look at this as there's a lot of momentum weight to the downside because, again, when you have something that's like showing here, that gap down below this near-term support, from a distribution function, the probability of this hitting, let's call it 39. So if this is 39, the probability of this hitting 40 or 38 will be very, very similar, even though from a market momentum perspective and stuff, I don't personally view it that way. Which is why you can find some edge in that side of things. Mr. Igor says, is there an actual amount you'll stop grinding and just collect the SPY dividend? I don't think so. I mean, from a trading side of stuff, I love markets. Markets are super fun. So it's not even, I don't even view it as a grind. To me, it's like a fun project that I get to work on and use as a vector to learn, because markets always introduce me to more things. And I am one of those kinds of people that is just naturally curious. If anybody's listened to me talk for any period of time, you've probably heard the word fascinating or fascinated like 62 million times, because it's the genuine truth. There's so much about this stuff that genuinely fascinates me. It's kind of like learning about space. Space is another thing that I spend a lot of time learning about because it's just so interesting to me. It's such an enigma. And it's the same thing here. So I don't really think that there's, at least for me, like a grinding element to this. Now, in terms of like positioning and stuff, there's a reason why I position some of my portfolio what I would consider to be lazily compared to actively trying to grow it at all costs and stuff like that. Because although I'm always trying to grow, there's not the same need to grow at the same rate. So yeah, it's an interesting question, but I don't think so. Like, I think that there will always be part of me that will continue to trade. I very much expect this to be a forever thing for me. That's one of the cool things about trading, if you think about it. And that's one of the reasons why I paint it the way that I do to you all. Because unlike just about everything else that you get into, trading is essentially always there. Like, there's always a role for speculators in markets. So there's always an opportunity to get involved and to do stuff, which I think is super cool. There's nobody that you have to answer to. So it is all a pure self-driven thing that you get to do. There's no customer, there's no sales calls you have to go to, there's no bosses that you have to report out to, other than, well, that's a lie, because you guys know I have the big boss, Thor, the portfolio manager, and sometimes he can have really significant looks of disappointment in his eyes. So maybe that is like I do have a pretty rough boss, but most people I think have easier bosses from a trading side. So yeah. Lauren says I spent my day grinding a few $20 wins to make up for my losses and about to have in Jan. Got my book today though. Got to be careful though for like the $20 wins and stuff, Lauren, because based on how much you're risking and like what you'll actually make post tax and post fees, it just sometimes isn't worth the amount of transactions that you might be taking. Because the other thing that you have to be really thoughtful of is wash sales and how that can impact the way that you, the end of year can look for you. So I would just be thoughtful of that. And then Mr. Igor, let me know if that answers your question. I know it's kind of a non-answer, I suppose, but it is like my personal answer. All right, let's run through this personal watch list real quick, and then we'll start poking through the focus topics. So PDD, I actually want to sort this by symbol. Okay. AAOI, Aaron. AI is down. APP is still. This was such a great exit. Literally like a textbook exit. Almost top tick this, and then now it's been rolling sideways for a bit, which I've told you guys, I fully expect it to do that. It has to consolidate after that kind of move. ASTS has been straight sideways, but notice this descending. I drew this a while ago. This descending line. I still have alerts set all the way up at 33, whereas the alerts actually need to slide down a little bit now. This is more for my like popular stock tracking kind of stuff to see what might be gaining more attention. Now, the one good thing is it does seem like there's a pretty strong floor priced in. I mean, this is a massive consolidation. So this is one of those ones where I probably will set like I'm trying to see it. It's harder on the small screen. Probably like right around here. Set early warnings to potentially get in, but it would be early entries, like noted early entries. But with such a strong consolidation here, it just does not really want to drop below 20, which I think is super solid. BILL, this looks like it might be about cooked. We'll see. Yeah. I don't really like this. From a consolidation standpoint, this is like really, really sloppy. So I'll keep an eye on it if there's any resumption of momentum, but not expecting much. Carvana is done. Glad I got out of that one. Trump, we walked by Trump Tower and can report firsthand Trump Tower is very busy. There are lots of people there, lots of people taking pictures. Also, we went into a Tiffany's, which was really interesting because Tiffany's like this bougie jewelry thing that also they had like plates and shit. But the interesting about it is that it was like a 9-story building. It's huge. And there was a fucking restaurant in it. But that was another spot that was popping off. In phase rolling over. Ion Q. This looks good to me. This gets another alert. And then this becomes downside. Only downside is there's a reason why you have to pay really close attention to trades like this, though, because you notice how big these candles are. You have to be on it like white on rice, because they can start getting out of hand really fast. That's where we are now. Lucid. It's trying, but it doesn't look good. Lunar, this was a good exit as well. Convenient timing on that. Mara looks bad. MSTR starting to roll over. MSTI. Meh. Novavax looks terrible. Oh, Alto rolling over. This one's interesting. The fact that this is rolling over like this. I was kind of eyeballing this, but I'm glad nothing came of it. Sitting 11 here. And then while I'm doing this, if there's any other stuff that I should add to this, let me know, to this watch list. This is one that I typically go through on a regular basis, so I can pop back through and add stuff that you guys want to track together. PDD, P. Diddy. This one's really strong from a risk premium play. Really, really strong. So kill this off. I mean, yeah, you're going to step in front of some gamma. That's for sure. What's your theta decay here? The nickel there. And a nickel here. What do we got, like, out here? We have straight as liquid. There ain't shit you can do in there. And then this is giving you 4 cents. And then this is giving you 3 cents. I probably, personally, even though this is further out than I typically would go, for something like this, I would actually go further out. The reason is I'm trying to tailor off some of that gamma, right? I cut my gamma in half by coming out 63 days, and I'm losing 2 cents a day from theta here, and I'm losing a penny. So 3 cents total per contract in theta that I'm cutting off, which, I don't want to lose that, but by cutting gamma in half, worth it. So this will be added to the watch list. And when I say watch list, this is watch list for paper trading. Because again, even though I am traveling, this skill set of scanning, I think, is so important to maintain and devising trade ideas. But I wouldn't put stuff like this on while I'm gone. Especially like here visiting family and stuff in New York, it's a little bit different because I'm still, on the computer a lot and just looking at markets. But when I'm in like Calgary and going through Banff and whatnot, the internet and all that kind of stuff is probably going to be a different story in some of those spots. So this will be added to a watch list. Reese says, why do you plan on losing in Jan? Lauren says, it's not looking good on some of them. I put them on a while back when I knew even less than I do now. I only started trading options in July. Well, Lauren, what I can tell you and give you credit for is that you've definitely been coming a really long way. One of the things that I love hearing from you is when we're talking about something and then you'll say something like, I understood that part, which is great. That's the game, especially being less than a year in. I think you genuinely are doing a good job from a learning side. I think the only thing from you that makes me a little bit nervous. And it's the same thing with a lot of people. And this is, I mean, if I'm being completely honest, it's the same thing that I would be doing, is just like doing too much too early. Like, that's what I think. Because again, like to your point there of like trying to scratch together some $20 wins, even though you might get some $20 wins, it doesn't, that's not really going to move the needle for you. And I think for newer traders, the ultimate focus is trying to build a skill set, going back to my original point on trading being something that you can straight up do forever. And yeah, so that's my TED Talk. Harvey says, "Do you have a general rule on the latest to exit, like say no longer than 21 DTE as Tasty Trade emphasizes?" No, I don't. The rules that I have for stuff like that are going to be very specific to the individual strategies. I don't really do overarching rules like that, and it's genuinely because you lose so much potential edge and opportunity just trying to look for like a simple rule of thumb or way to do stuff in a standardized way. Now, what I will say is there are absolutely a lot of guidelines that I use. So like, for example, the fact when I was modeling that short strangle in PDD saying 63 days is a little bit long. So I normally wouldn't go quite that far out. But I think in terms of like holding duration, stuff like that, funny enough, what Tasty talks about of holding within 21 days is actually pretty reasonable. That jives with a lot of what I've seen, but I also think because I apply more of an active management, I absolutely will take trades in within that time frame. And it's because you can gain a lot of the profit for the trades within those periods. So while sometimes you absolutely will see something that you offer out at 50 days, come 20 days, looking like a solid profit, and then if you take it into like 5 days or 7 days, you can see it completely reverse or roll over. That will happen. But the frequency on that is relatively infrequent, because one of the things you have to remember is when they're doing their studies on the indices more often than not. And the indices give you a view of things, but it is a specific view. It's not indicative of broad markets. And that's one of the things that they sacrifice when they're doing these studies, is because they're doing studies on a select series of tickers, and then they're applying that methodology across to everything. And you'll lose some sensitivity in doing something like that. It's what they teach for something like that is the absolute definition of trying to come up with a rule of best fit that works well in most circumstances, and they're prioritizing ease of implementation over optimization, which is cool. I have no beef with that at all. But that's exactly what's happening there. So yeah, I don't. Now, for something like this, and let's use this as an example. This is a great example. So let's take a look at what our gamma becomes at 28 days for those 16 deltas. Gamma here is a 2 gamma, and then gamma here is a 2 gamma. Now let's go to 21 days, and let's go to those 16s. There's nothing at a 16, but it would be about a 2 gamma. That's what I see here. And then on this side, it would be probably a 2 or 3 gamma. So similar. Now let's go to the 14, and let's take a look at the 16 delta. Now you're at a 3 gamma on this side, and then you're at a 3 gamma on this side. So you're pretty much at the same gamma as you were at 21 days at 14 days. So you've not really increased your total risk movement yet. Then if we go to 14 days, 3 gamma, 15 days, 3 gamma, about same. And then 7 days at a 16 delta, now you have a big jump. Now you go to a 5 gamma on the call side and a 5 gamma on the put side. So going from the 14 DTE to the 7s, crossing over that window, that's where you're seeing all the gammas spiking. The difference in gamma from 10 Jan, which is 21 days, the 17 Jan, which is 28 days, and the 3 Jan, which is 14 days, is not that much. It's about 1 to 2. So again, this could be the kind of thing where artificially managing here can slow down your total return profile pretty meaningfully. And again, it's not actually saving you from some sort of ton of risk coming off. So that's the general idea there. Okay, let's finish going through this list. I think there's only a few left. That's PDD. Palantir looks super strong. This I actually remember cracking an alert today. Yeah, this looks really good. Palantir I like. There's, again, this is one that would be a paper trade, but I like this one. RGTI looks terrible. Riot looks terrible. Rocket Lab does not look good yet. SoFi does not look good. SQ does not look good. Tesla does not look good. That's most of those. Let me run through one other scan really fast. I have a scan that I've been running for price movement. Let's do this one. RCAT. Okay, I'm going to move this out of the way just because I'm working on a small platform here. I'm going to move this out of the way so that I can eyeball. What I want to do is run a few of these down. So RCAT's been on here a few times. Yeah, so RCAT's starting to look good. I'm going to add that here. RGT is another one that I've seen several times. That's slow down though. APP's on here now. That's right there. Let's do QBTS. That's another one. Which I think we should watch this one from a AI slash quantum computing, mostly quantum computing perspective. RDW is another one. We should probably also add Reddit. RDW. Yeah, we'll do this one. RDW. And then RDDT. Anything else that looks good to us to add? No. Hood. Let's check out Hood. That's so much. Robinhood is so awful and lame. Everything about them sucks. And this one looks good. Well, this one. Eton. UFIN. Exxon. Oh, we have to add CLPT. CLPT. Yeah, let's add this one. And then MVCR probably. MVCR. Yeah, definitely. That's a good strong gap. Cool. Oh yeah, Tiva. We gotta get that one too. Tiva. Yes, sir. This popped up on a couple scans on Price Surprise Up. And then maybe Vertex. Or is it, what's the ticker for Vertex? VRTX? Oh, Okay. Sweet. So let's pivot now over to the focus topic. Let's talk about this for a minute. And I want to spend a little time actually doing this with you all so that you can have a solid sense of how to do this for yourself and what you think. So, Lauren says KINS. Is that a ticker? KINS? What is this? Casualty insurance. Didn't we look at this not too long ago? This name is familiar. I feel like we looked at this not too long ago. This looks great. This is downside. The breakout today is on really, really good volume. This is a good find. Let's see. Let's see what it looks like inside. Yeah, the 118s are pretty liquid. The 63s are terribly illiquid. But these are fine. Something like these 17 and a halves. Get in these for 305. Stop becomes 1503. That dumps you out. That's a 15% move. That dumps you out for 142. And then for what's the probability of that? 142. Let's do sometime in the next month. What's the probability of hitting 1503? 45, so really, really solid chance is per this of getting stopped out. 45, and let's see what's 45% to the upside. 45 would be 2045. What do we make at 2045? 2045. 183. Yeah, it's a solid trade. So what I'm doing here, for those that don't know, this is a different style of analyzing something. And what I'm doing is I'm looking at what's the probability of me being stopped out, and then what's the commensurate probability of me hitting the equal probability of a touch to the upside, profit factor. And then I'm looking at the pricing. And I'm seeing, so like in this case, I have roughly a 45% chance of hitting either 15 or 2046. Both of them are about 45% chance. So then, but I make another $40 if I hit the 2046. So that does me actually a favor. And this is one of the cool things about buying options, that people that are too myopic with how they evaluate and choose to buy things, they won't catch this kind of nuance. And the nuance here is, as it moves in my favor, I gain advantageous deltas. And as it moves against me, it naturally slows down. I'm going to take a pause on that, and I want to make sure that you guys understand what I just said and why that's important. Again, because I'm still kind of bundling in the beginner element for tonight's live stream, even though it's not a set options trading basics. Does what I just said make sense? It is one of the benefits of buying options, and it's one of the things that gives long options. Long options, according to Theta Gang, Theta Gang wrongfully hates on buying options because they don't understand. Lauren has it. See, Lauren, how cool is that? That you understood the concept of what I was just saying. Like, that's awesome. And Hater, absolutely happy to explain. I really have to figure out like some sort of mobile drawing setup. If you guys know of something that would fit that use case, I literally would love it. Like a mobile drawing setup would be really good. That would be super, super helpful. Actually, I think I have a touch screen. Isn't this a touch screen? Hold on. It is a touch screen. So I just need like a stylus, and then I can literally draw it on the screen. Great idea, guys. Okay, so let me explain it to you, hater. Let's pretend that we bought this 17.5 option, and we bought it in Kins. Our 17.5 option, it starts at a 61 delta. So let me grab this. Let me find a random spot. So 17.5 strike with the stock at 17.7. Now, our gamma starts at 0.05. This is our original gamma. And our original premium is 305. Oh, that's lame. Hold on one second. It literally just said that there was an ad inserted. It should be off. I just have to like keep pausing it. So this is your original delta, and your original premium is 305. Or gamma. And your original delta is 0.61. So this is premium. This is delta. This is gamma. This is what the stock at 17.7. Like this. So now, let's do two scenarios here. Let's do stock at 18.7, 16. I guess I'll keep it the same as the options chain, 16.7. So now, first things first, let's track what happens to our gamma. It goes to 18.7. What's our delta in this scenario? I was just going to do it, but then I realized you guys are more than capable of doing this. So what's our delta if this stock goes from 17.7 to 18.7? Guesses or answers. I think you guys know how to answer this one, so it probably doesn't even need to be a guess. My assumption is that you know exactly how to answer this one. Also, since there's no DoorDash order for tonight, well, I don't know what we're doing for dinner, but the game plan is to just probably walk around and eat pizza until we find something. So no DoorDash order tonight. Sorry, guys. No guesses? What's my delta here? You guys know this. And what are these numbers? For the oh shit. What are these numbers here? If the stock goes up to 1887, what are these numbers? So we are all wrong so far. This is good. I'm really glad that we're doing this because it is very clear that this needs to happen. Let's start from the left. How do we calculate the premium for this, for the 18.7? Premium delta measures the rate of change of an options premium. So ceteris paribus, everything else remaining the same, this becomes 3.66. This is our new premium. Delta changes by what gamma tells us. Gamma is the rate of change of delta per 1 point move in the underlying. So here, our delta becomes 0.66. And then gamma, there's a Greek that tracks what gamma would be in this. However, we can also just kind of eyeball it. It doesn't matter quite as much. Gamma, as you can tell, it would be about the same. It would be 0.05 for a 1 point move. So this would be 0.05 still. So now to the downside. If we take this to the inverse, we have $3.05. If the underlying moves down by $1, this becomes 2.44. And then delta would change by what our gamma is. So it's 0.61 less 0.05, which is 0.56. And then gamma, just using the options chain as a proxy, it would probably still be 0.05 without calculating it directly. Okay. First things first. Are there any questions on what this is, what I just showed you? And then this is going to go back and answer the original question that was asked by the, well, not really asked, but when Hader was explaining that they didn't fully understand what I was explaining before. So first things first, does this make sense? Are we all comfortable? And then I think I mixed these up. Technically, these are, hold on. I was wondering why these numbers look so wrong. Everything we did in the example is completely fine. It's just the difference between the stock and the strike. So this should be 0.5, and then this should be 0.5. Everything else is fine. Reese says, which Greek tracks changes in gamma? That's a fantastic question, and I will provide you with an answer. The answer to your question lies in this video. You watch that video, it goes through first order, second order, and third order Greeks. No, Reese says secondary Greek. No, it'd be third order Greek. Because remember, first order Greeks track everything with respect to a change in option premium, a 1 point move. So for example, delta tracks the rate of change of premium. Theta tracks the rate of change of premium. Vega tracks the rate of change of premium. Rho tracks the rate of change of premium. So the first order Greeks track rates of premium changes. Second order Greeks then start tracking behavior of first order Greeks. So gamma tracks the rate of change of delta. So then a third order Greek is what tracks the rate of change of gamma. And the fun part about this is the further down the rabbit hole you go, you'll actually learn that there's technically fourth order Greeks. It can get really in depth pretty fast. It's not exactly the most useful thing, I think, for people, but it is, I don't know, I feel like it is useful. So yeah, the main thing is, I think who was asking that? Was that Reese? Yeah, Reese. So for Reese, there's a couple things that track how gamma moves. The pieces you want are color, speed. You also want Zama. these track rates of change of gamma from different perspectives. So color is known as gamma decay. Speed is kind of like the gamma of gamma. And then Zama is gamma rate of change. It's kind of like d gamma d vol. It's respective to volatility. So these three would be the source of answer for you. Lauren says, so gamma is kind of important. Gamma is really informative because gamma teaches us a lot of different ways on how we might want to build a trade. So, for example, going back to this original answer that we were talking about, and this is specifically for Hater, because Hater asked us to repeat it again and make sure he understood. So when you have an option, that's when you buy an option and it goes in your favor, it goes in your favor faster than when it starts going against you. So what this means is notice the rate of change of premium in these two different scenarios. So let's just do the math really quick. So this equals this minus this divided by this expressed as a percentage. And then this equals this minus this divided by this expressed as a percentage. What will happen is as this starts to move more, we get another dollar move. So these are obviously going to be the same right from the jump because they're applying the same delta, right? This is moving from the first point. So now if we play this game one more time, and you don't even really need to see the change in price, you can just take a look at the difference based on this and this value, right? So then this would equal this divided by this. And then this would equal this divided by this. So let's say we have 19 point. Was a percentage. When you have something that's starting to move against you, you'll notice two different things. The first thing is as a percentage of the remaining premium, the decay will look very fast. But as a raw number, the decay in terms of your option losing value is decreased. Because take a look here. The reason why these are larger percentages is because this is saying this $2.44 is going to move by 56 cents, right? That's a larger percentage. 56 is a larger percentage of 244 as compared to something that has a larger denomination, in this case 366, moving by 0.66. Now, the reason why long options have a bit of a benefit baked in is because if you get a 1 point move in your favor as a gross dollar amount, in this case, you on the next point move after that, you can make $66 or 66 cents on the next point move. In this case, you lose 56 cents. So you lose less as a gross amount. And that's because as the option decays, even though the percentage decline will be significant because it's a larger total amount on a smaller number, that's going to continue decreasing. And to the inverse, as a percentage, it will actually slow down. Deltas as a percentage of the premium, but it's because the premium is growing so much as a raw number. So the way to summarize that entire thought is the reason why buying an option, whether it's a call or a put, has a built-in buffer with respect to movement is because as the option goes against you as a gross amount, as your delta decreases, it hurts you less because there's only so much premium left in the option. Inversely, as it continues to move in your favor up until it hits a delta of 1, delta will compound more quickly because as this moves in, the gamma is going to add on to your delta. And then this, in the next step, would go from 66 cents to 71 cents. So that means you get another 1 point move in this scenario here, and you would make 71 cents. In this case, you would lose 51 cents for the same 1 point move. If we go from 16.5 to 15.5 or 18.5 to 19.5. So this is like the built-in braking system that comes with long options that absolutely give it a benefit. Again, it's comical to me when people will say like, oh, selling is better than buying, because there is no inherent edge to one over the other like that. Again, like if there was, nobody would take the other side. Why would they? It makes no sense. So I'm actually going to change the focus topic for tonight so we can talk about this a little bit more, because I think it's actually a really, really good conversation. And there's a few more things that I think we can dive into. And then we'll wrap up so I can go get some more pizza for my fat face. YouTube. And then this one will be long option, and let's do delta and gamma, because I want to explain another thing that I think will be useful. And then this will be for hate. So let's take a look at one other scenario. Decoding says, how do you apply this thought in your trading? It's a great question. It's a really, really great question. So if we go back to the original example that we were looking at, what was the ticker? Was it KINS? This one. The way that I apply this in my trading is I know if I'm analyzing something that has the same probability move or same probability of a touch to the upside or downside, that I will make more money on the long option than I will lose on the short option. And to reiterate that point, if we have a move down to 1503, which I forgot what the probability was. Let's just double check it. A 44.7% chance, something like that. So there's a 44.7% chance of us hitting 1503. And then the probability of us hitting 2046 is also 44.5 or whatever it was. I picked something that was close to it. Now, between those two scenarios, I only lose $142 if I'm wrong, but if I'm right, I make 183. That's the natural braking system that's built into options. It's one of the reasons why I like options so much for trading directionally like that. Because think if you did this with long equity. Long equity, you make the same, up or down. There's no baked in helping function for your position if you're wrong as compared to something like this. If you did it with a long equity, you literally have 50-50 chance. So you would have a 45% chance, let's just call it 45% chance of losing the same amount of money on the same probability. That's neutrally expectant. There's no edge into that for you. And let's just use this scenario, so hopefully it'll make sense. So if we have a 45% chance of making, well, let's just take a look at what the actual move is, because I don't know off the top of my head. What is Kins even trading at right now? 1773. So 1773. And we're saying the probabilities of it hitting 1503 and then 2046. I'm doing this for the long equity side. So let's call it 2.7 for both. We won't round it. So for the long equity expected return calculation, we're saying that there's a 45% chance of us making, so let's just call it $2.70. Well, 270. We'll make it all 100 lots, so it's the same. And then we have a 45% chance of losing 270. So if you run your expected return calculation on this, oh, I messed up on this, my bad. This should just be this. What is the problem it's having now? Oh, I fucked this one up. What did I hold? Must have held a weird key. This should just be G. Notice your expected return. Here is 0. Now let's do it with an option. We have the same thing in terms of probabilities, 45% chance of hitting the top line item. However, at the top line item, we make 183.85. And then for the bottom line item, we lose 142.70. So in here, our expected return is positive 18.52% for the same exact event. So decoding Kitty, the way that I integrate this into my approach is I know this. So if I don't have a strong directional assumption on something, then let's say I wanted to play this. Which one would I prefer to play this with, provided that the options are liquid? Would I prefer to play this with equity, or would I prefer to play this with options? And the answer is really simple. I would much prefer to play this one with options. And that's how I use it to inform the decision-making process, because this is a equal probability scenario for both of these things, but because of the behavior of the instrument, there literally is a baked-in edge for the long call. Now, this isn't not all that glitters is gold, because I'm talking about this in a constrained environment. We're talking about delta and gamma. There's other elements that make this more challenging than long equity, because for long equity, you don't have to deal with changes in volatility. This will have a Vega function. This will have a certain percent change in volatility will hurt this trade, as compared to that change in volatility won't bother the equity trade at all, which is why the long call will have a better expected return when we isolate for delta and gamma, because you're taking on more risk now because you're adding rho, you're adding a volatility element. So the way that I use this understanding here is it provides a natural breaking function for when I'm trading things. Decoding Kitty says, would you hedge this trade? Absolutely not. Hedging is a disease for especially retail traders. Hedging, I think, has become one of the worst possible things retail traders have fallen in love with thinking that they should be doing, and I genuinely don't think the majority of instances they should. I think it's a case where retail traders have heard that institutions do this, and then they try to mirror it thinking it's smart. And in the vast majority of instances, I don't think it's very small. That's not, I do hedge periodically. And I mean, now I essentially don't hedge, but the times I would hedge is back when I was rapidly growing my account. And during that account growth phase, if I'm taking significant leverage, then you have to hedge, because then the probability is like probability of blowing up might not be huge, but again, going back to the RACI chart, the severity of blowing up an account is tremendous. So you have to carry a hedge logically in those kind of scenarios. Lauren says, what's hedging? Great question. So hedging is, think of a vertical spread. A vertical spread is a built-in hedge. So let's say that let's go to SPY just because it'll be more liquid. And I'll show you what it is. The short version of hedging, it's reducing risk in some way. And there's different ways to reduce risk. So let's say that we wanted to buy this let's do this one, the 594. Let's say we wanted to buy the 594 put. We wanted to run the market to the downside. So we want to buy this put. Now, our max loss in this trade is 976. So what we can do is we can say, well, let me sell the 595. And what that does is hedges my risk. Actually, I realize I did the wrong one. My bad. What did I do? The 595. So we'd have to buy this one or sell this one. So what I do here for the prospect of hedging is I say, well, I don't want to potentially lose 976. So I'm going to sell the 593 and then I'm going to turn it into a vertical. This decreases my total risk. My total risk now goes down to $8. Now, the trade-off here is, let's say that I get a 15% move in my favor. If I get a 15% move in my favor on the vertical, I will make $92. If I don't have the vertical and I get that 15% move, I will make $8,091. So the nature of hedging is you offset some of your risk by giving up some of your profit potential. And I think for retail traders, it becomes more of a disease where retail traders just don't like the idea of losing or having trades not go their way. So they want to hedge things. And what they're doing is essentially decreasing their ability to make profit. And they're just satiating their ego so that they don't have to look at themselves and have losing trades, which is the main problem. My argument is, for the vast majority of traders, is if you size things appropriately and maintain good diverse correlation, you inherently are reducing your risk. So, Hater says, wouldn't be hedging great for black swan events? Of course. Well, it wouldn't be great, actually. I redact that. Hedging would be terrible for that. Because if we have a black swan event that we somehow know is coming, what would be great is to exit all of your positions and then to play the black swan position. That's what would be great. But the problem with that idea, obviously I'm being a little bit dramatic in the way that I'm framing it, and that's on purpose, is because you cannot detect when a black swan event is. And more importantly than that, black swan events are typically very, very rare. So the problem, Hater, for people in that case, is hedging is very expensive, and we are overpaying typically for something that's very rare and might not occur for a very long time. So my argument for retail traders is that they would be light years better off just sizing things, that makes sense. If you size things appropriately, you get rid of the need for a hedge and you simply manage your trades as you should. So yeah, the desire to hedge, it literally becomes a disease. And I see it all the time. I see traders on Reddit a lot with this one, where they're like, hey, how do I hedge? I want to hedge, the market's moving. So yeah. Harvey says, so hedging impacts your risk reward ratio massively. Well, it's a choose your own adventure, because the hedge can now, okay, let's actually talk about this. Let's get into a little bit of detail on this really quick, because I think it's a great topic. Because most people, when they're talking about hedge, they're literally just wanting to hedge, feeling uncomfortable because they're showing a loss. They're not actually looking to hedge what we would consider to be a black swan event. So let's talk about that. Let's say that you have 500 shares of SPY. And let's say that we think a black swan event could be there or whatever. And let's say we think it might run down to 400. So in this case, you would lose $96,000. Big loss if it runs down to 400. What most traders try to do for their hedging is they don't want to lose much at all. So what they can't, well, they might try. Let's say that you come out here to the 91s, and let's say that you want to cap your downside, and we're getting it at 592. So you're going to buy the 555s. If we buy the 555s and you get 5 of those, you now cap your downside to 22,165. Now, that's if it goes to 400. If the stock drops 5%, here you lose 10K. Without that put, if it drops 5%, you lose 14K without the put. With that put, you're going to pay $3,500. So if we're actually trying to protect against the black swan, what the way that most sophisticated entities will do it is by going further out in time, really far out in time, because you're playing a big price movement. And what did I just say that other one would run us $3,500? So let's find something that we can get $3,500 worth, something around like a 5 delta. Maybe these 435s. And these you can get like 16 of them. So now, the way that we actually hedge, like a true black swan event, is rather than overpaying for a really tight delta and still having a very uncomfortable size loss at a big move, in this case, like if it drops to 400, you lose 22K. What smart traders do is they buy units. And notice how in an actual black swan event, in this, you cut your loss down massively. Your loss in here comes to 13K. But notice what happens to the loss in the interim, 21 and 27K. We compare that here, it's 17K and 21K. So you have a much better loss protection in this middle zone. This is everything to do with that gamma and delta relationship. When you're actually trying to hedge a black swan event, you grab what we call units, because you can buy more of them because they're cheap out of the money options. And they don't decay as much. But if an actual black swan event happens, this isn't like I'm slightly uncomfortable because the market moved event. We're literally talking about an actual black swan event. So a black swan event for something like this would be like a negative 40% move. Like, that is a black swan event. That is a massive change in price from something. Or we can even go lighter than a black swan event, and we can say maybe we think the market might drop 25%. If we take a look at comparatively between these at 25%, this you lose 22K. This you lose 28K. So when we're talking about actual black swan hedging, we're talking about an actual big move. We're not talking about hedging small market micro movements. We're talking about hedging when we go through something like COVID. And COVID is actually a bad example, by the way, because it was so short lived. But COVID, as an example, we ran from 333 down to 220. That's a massive down move. So the way that you hedge for a black swan event is completely different than what most people refer to on normal parlance of hedging. Most people hedge simply because they don't like showing a loss. They don't like seeing a losing trade. It makes them uncomfortable. They don't like it. So then they don't want to see it. And the other thing that you'll see that's a complete disease around hedging is most traders have this perverse concept that they'll be able to profit on the hedge and then wait until it goes back the other way and then profit on the other side. An actual hedge is designed to keep you in the game because you're not trying to make money on your hedge. You want the hedge to lose because then that means that the main position is working. So the here is, let's say that you do get your black swan event. So let's say that you have your units built, and let's say that the market starts dropping 40%. Well, when do you take your hedge off? When does the hedge come down? You're making money now, which is great. Your long shares are going to be looking terrible. When does the hedge come down? Who says it stops at 40%? It went past 20. It went past 30. It went past 35. It just hit 40. Who says it doesn't go to 45? Who says it doesn't go to 50? Who says that it's not a Black Monday event? So the problem that people run into when we discuss hedging is we also have zero thought process applied to how do we logically unwind the hedge. Because as soon as you unwind the hedge, your protection is gone. The very thing that we put on to protect our risk is now removed. We now take on the risk again. So there's a lot of ways to do it, by the way. It's not an unsolvable equation. For something like this, it's actually really simple. What you do is you start scaling out of the hedge as it gains deltas, and you maintain the same overall delta protection. Because when you first put this on, you have 500 long deltas, and this has a max of, whatever number of deltas. What is this showing me? Negative 88 deltas. So then in this case, by the time you get this negative 40% move, your negative deltas here would have expanded so much you're actually making money. So then you maintain the same level of protection. You just scale it off. It's super easy. But the problem is nobody thinks of that. Everybody just thinks like, I'm just going to make money on the hedge. They'll take the hedge off when this is a fraction of a profit or no profit. And then the easiest scenario here is just as the stock starts rolling over, just get out. Just exit. Just manage your damn trade. And then wait until it looks good again. And then you can re-enter. Or if you're trading something like a covered strangle, you can scale back into it, or you can scale into it as it's going down. That's one of the reasons why using leveraged ETFs is so beneficial for something like trading the covered strangle, is because leveraged ETFs, they compensate for not being fully invested all the time. So it's a really fun conversation, and that actually gives me an idea. I'll take a note about doing something like hedging options trades. Cool. I just took a couple notes, and then I'll make a video on that at some point. So hope that's useful. All right, gang. time for us to sign off. We're going to go frolic around, see what we can find. There won't be a live stream tomorrow because we get back a little bit later, but then there will be probably a couple live streams on Sunday. I'll do one for everybody, and then I'll do one with the Outlier Pro members. So, as always, if you guys need anything, let your boy know. Be an outlier. I'll see you guys later.